In 2010, a programmer bought 2 pizzas. He paid 10,000 Bitcoin to do it. At today's prices, those 2 pizzas cost over $300 million. Now, before you feel bad for him, here is the part that actually matters. At the time, everyone had access to Bitcoin. It was public. It was available. The information existed. Most people looked at it and said, "This seems too weird. This seems too risky. I'll wait until it makes more sense." And they waited. And they waited. And they are still waiting. Right now, in 2026, a new category of digital assets is emerging. Institutional money is moving into it. Governments are writing legislation around it. The infrastructure is being built at speed. And most ordinary people are doing exactly what they did with Bitcoin. They are waiting. In this video, I am going to walk you through 3 specific digital asset categories that are attracting serious institutional capital right now. What they are. Why they matter. What the upside looks like. And, because this is WealthVerse, what could go wrong? I am not here to hype you into buying something. I am here to make sure that 5 years from now, you are not sitting at a kitchen table thinking, "I knew about that. I just waited." Let us get into it. Every major technology shift has a moment where you can tell it is becoming real. It is not when the price goes up. Prices go up on things that go nowhere. The signal is when the institutions arrive. In 2024, BlackRock, the largest asset manager on Earth, responsible for over $10 trillion, launched a tokenized fund on a public blockchain. $10 trillion. And they chose to build their product on new digital asset infrastructure. Fidelity followed. Franklin Templeton followed. J.P. Morgan built their own private blockchain for institutional asset settlement. These are not companies that take risks on experimental technology. They are companies that move when they are certain something is becoming the next infrastructure layer of global finance. Here is what makes this moment different from every crypto hype cycle before it. This is not speculation about what digital assets might do. This is the actual movement of real-world value onto digital rails. Real estate. Government bonds. Commodities. Private equity. Physical assets with intrinsic value, being made accessible, tradable, and divisible through digital technology. The tokenized real-world asset market was effectively zero in 2020. By 2025 it had crossed $20 billion. Analysts at major banks are projecting $16 trillion by 2030. $16 trillion. To put that in context, the entire current cryptocurrency market at its peak was under $3 trillion. This is not a bigger version of what came before. This is a different category entirely. And most people are still confusing it with crypto. So let me show you what is actually inside this space. 3 categories. All different. All serious. Category 1, Real-World Asset Tokenization, RWAs. The concept is straightforward. Take a physical asset with real value. A commercial property, a government bond, a gold reserve, a work of art. And represent ownership of it as a digital token on a blockchain. Why does this matter? Because it destroys the entry barrier. Today, investing in commercial real estate requires hundreds of thousands of dollars in capital and access to the right networks. In a tokenized world, that same property can be divided into 1 million tokens. You can own a fraction for $100. You receive a proportional share of the rental income. You can sell your fraction in seconds, not months. The lock that has kept the most valuable asset classes in history reserved for the already wealthy, tokenization breaks it. Platforms like Ondo Finance and Maple Finance are already managing hundreds of millions in tokenized treasuries and real estate. This is live. This is running right now. Category 2, Decentralized Physical Infrastructure, DePIN. This is the one most people have never heard of. And it might be the most interesting. The idea, instead of corporations building and owning the physical infrastructure of the digital economy, internet networks, data storage, energy grids, wireless coverage, individuals build and own it. And they get paid in digital tokens for providing that infrastructure. The Helium network has over 1 million user-owned hotspots providing wireless coverage across cities worldwide. Owners earn tokens every time their hotspot is used. The network is worth hundreds of millions. And it was built by ordinary people with hardware they bought themselves. This is infrastructure capitalism flipped upside down. Category 3, AI Compute Tokens. AI requires enormous amounts of computing power. The demand is outpacing the supply from centralized providers like AWS and Google. A new category of token is emerging that allows individuals to contribute computing power to AI networks, and earn rewards for doing it. You stake your GPU. The network pays you in tokens. The more AI demand grows, and it is growing faster than almost any technology in history, the more valuable that contribution becomes. Now, before you feel like this is all upside, it is not. And this is where most videos stop telling you the truth. Most of these projects will fail. Not some of them. Most. That is not a reason to ignore the space. Early internet companies failed at the same rate. But the internet did not fail. And the people who understood which infrastructure would survive built extraordinary wealth. The people chasing hype lost everything. Here is what the risks actually are. Risk 1, regulation. Governments around the world are writing legislation for digital assets right now. In most cases, those laws are not written yet. Which means the rules of this space could change significantly, and quickly. A token that is legal today could be classified as an unlicensed security tomorrow. That has already happened. Multiple times. Understanding the regulatory direction of any project you are interested in is not optional. It is the first thing you need to know. Risk 2, smart contract failure. Digital assets run on code. Code can have bugs. Smart contract exploits, where attackers find vulnerabilities in the code and drain funds, cost investors over $3.8 billion in 2024. That is not a fringe risk. It is a structural feature of early-stage technology. Any project that has not had its code independently audited is a project where this risk is unquantified. Risk 3, liquidity. Many of these assets are easy to buy and extremely difficult to sell. When market conditions turn, the price going up when everyone is buying is not the same as having real liquidity. In a genuine market downturn, some of these tokens could become effectively impossible to exit at any reasonable price. These risks are real. They are manageable. But you have to know they exist before you put any money anywhere near this space. So, knowing all of this, how do you actually approach it? 3 principles. Non-negotiable. Principle 1, only use regulated, audited platforms. Where you hold digital assets matters as much as what you hold. The collapses that have destroyed billions in this space, FTX, Terra, Celsius, all shared a common failure point: unregulated, opaque infrastructure. That collapsed the moment market conditions turned. Regulated exchanges with published audits, insurance on holdings, and a track record across multiple market cycles are not guarantees. But they are the minimum standard. Do not compromise on this. Principle 2, research before you allocate. 3 questions. For every single project. Who built it, and do they have a verifiable track record? Has the smart contract code been independently audited, and by whom? What does the token actually do, and does it need to exist? Or is it just there to raise money? If you cannot answer all three clearly, that is not a research problem. That is the answer. Principle 3. Size your position for the scenario where you lose it all. This is the rule most people skip, and the one that separates people who survive market downturns from people who don't. In early stage, high potential asset categories, position sizing is everything. A 5% allocation that goes to zero is a setback. A 50% allocation that goes to zero is a disaster. The upside in this space can be extraordinary. But the upside only matters if you are still in the game when it arrives. Protect your downside first. Everything else follows from there. Bitcoin was once something most people had never heard of. Then it was something most people had heard of but dismissed. Then it was something most people wished they had acted on. We are at stage 2 with this new asset class. The institutions have arrived. The infrastructure is being built. The legislation is being written. Ordinary people are still at the dismissal stage. I am not telling you what to do with that information. I am telling you the information exists. WealthVerse exists to give you the kind of financial intelligence that used to require being in the right room with the right people. We are here every week. No jargon. No agenda. Just what you actually need to understand where money is moving. Subscribe, and I will see you next week. Next up, I am breaking down exactly how RWA tokenization works end to end. The platforms, the mechanics, and the ones to watch. Do not miss it.